The U.S. banking system is in the midst of a seismic transformation. While the top four banking giants, JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo, have consolidated their dominance, regional and state banks are grappling with existential challenges. This consolidation of power has not only reshaped the financial landscape, but also exposed vulnerabilities in the broader banking ecosystem, especially for underserved communities, small businesses, and rural areas. Amid rising competition from non-bank financial institutions and fintech companies, these smaller banks face a daunting task: to remain relevant in an increasingly centralized industry. This article explores the dominance of the top banks, the role of non-bank disruptors, systemic risks from over-consolidation, the struggles of regional banks, and potential strategies to address these challenges. The goal is to shed light on the precarious position of regional banks and offer actionable insights to ensure their resilience. The Big Four banks in the U.S. collectively control over 40% of the nation's banking assets, a figure that has steadily risen over the past 2 decades. For example, JP Morgan Chase alone surpassed $4 trillion in total assets in 2023. Following the 2008 financial crisis, regulatory measures such as the Dodd-Frank Act aimed to stabilize the banking system but inadvertently fueled consolidation. These larger banks, equipped with robust balance sheets and access to diverse funding sources, have thrived in an environment where economies of scale and regulatory compliance favor big players. Smaller banks, in contrast, have struggled to compete. According to a 2023 Federal Reserve report, the number of community banks has decreased by 40% since 2000, driven by mergers, acquisitions, and closures. Consolidation stifles competition and raises concerns about systemic risks and reduced access to financial services in less populated areas. For example, in many rural communities, regional banks serve as the primary financial institutions. When these banks close or merge, it leaves a significant void affecting local economies and small businesses. Adding to the woes of smaller banks is the rise of non-bank financial institutions, including fintech companies and private lenders. These entities have rapidly eroded the market position of regional banks by offering innovative, technology-driven solutions that cater to modern consumer demands. Fintech firms like Square, PayPal, and Stripe have revolutionized payment systems, while companies such as SoFi and Lending Club provide alternative lending options that bypass traditional banks entirely. Unlike regional banks, fintech companies operate with fewer regulatory constraints, allowing them to innovate and scale rapidly. For instance, U.S. fintechs collectively facilitated over $300 billion in loans in 2023, capturing a significant portion of the market once dominated by smaller banks. Private equity firms have also entered the fray, targeting niche markets like small business lending and real estate financing. As customers increasingly turn to non-traditional lenders for financial services, the competitive landscape for regional banks becomes even more challenging. The consolidation of banking power into a few dominant institutions creates systemic vulnerabilities that extend beyond the banking sector. When smaller banks falter, underserved communities and small businesses bear the brunt of reduced access to credit and financial services. Rural areas, where regional banks often serve as the primary financial institutions, face economic stagnation when these banks close their doors. The concentration of assets in a handful of banks also heightens the risk of systemic crises. The collapse of Silicon Valley Bank in March 2023 highlighted the fragility of mid-sized and regional banks. SVB's failure sent shockwaves through the financial system, raising questions about whether existing regulatory frameworks adequately address the unique risks faced by smaller institutions. While the Federal Deposit Insurance Corporation managed to stabilize the situation, the episode underscored the precarious position of regional banks in an era dominated by giants. Several examples illustrate the challenges faced by regional and state banks in today's economic climate. First Republic Bank. Despite offering personalized services, First Republic struggled to retain its high-net-worth clientele amid rising competition from larger institutions and fintech firms. The bank's inability to match the technological capabilities and pricing advantages of its larger counterparts ultimately led to its acquisition by JP Morgan Chase in mid-2023. Midwest Community Bank. Serving agricultural businesses in Iowa and Nebraska, Midwest Community Bank attempted to fill the gap left by larger banks withdrawing from rural markets. However, its limited resources and outdated technological infrastructure made it difficult to compete with fintech lenders offering streamlined, digital-first solutions. By late 2024, the bank announced its merger with a larger regional player to remain viable. To address the fragility of regional and state banks, several strategies can be employed. First, partnerships with fintech companies. Smaller banks can collaborate with fintech firms to enhance their technological capabilities and customer experience. For example, Bank of Oklahoma partnered with a fintech provider to develop a mobile banking app, enabling it to retain younger customers and compete more effectively with larger banks. Second, leveraging niche strengths. Regional banks should focus on their unique strengths, such as deep local knowledge and personalized customer service. By tailoring their offerings to meet the specific needs of their communities, these banks can differentiate themselves from larger competitors. Third, regulatory support. Policymakers can play a crucial role by revisiting regulations that disproportionately burden smaller banks. Adjusting capital requirements and streamlining compliance processes can help level the playing field, allowing regional banks to compete more effectively. Fourth, investment in technology. Upgrading technological infrastructure is essential for smaller banks to remain competitive. This includes adopting digital payment systems, implementing advanced data analytics, and improving cybersecurity measures to protect against growing threats. Fifth, expanding community development initiatives. Regional banks can strengthen their ties to underserved areas by investing in community development programs. Initiatives such as low-interest loans for small businesses and affordable housing projects not only benefit local economies, but also reinforce the value of regional banks in these communities. The fragility of regional and state banks in the U.S. is a pressing issue that demands immediate attention. As the banking landscape continues to evolve, the survival of these institutions hinges on their ability to adapt to changing market dynamics and technological advancements. While the dominance of the Big Four and the rise of fintechs pose significant challenges, regional banks have the potential to carve out a niche by leveraging their unique strengths and forming strategic partnerships. Ultimately, a resilient banking system requires a balanced ecosystem where institutions of all sizes can thrive. By addressing the systemic risks of overconsolidation and supporting the growth of smaller banks, we can ensure a more equitable and sustainable financial future for all. Policymakers, industry leaders, and consumers must work together to create an environment where regional banks are not only preserved, but empowered to contribute meaningfully to the U.S. economy.